Something shifted inside the silver market this week that most holders have not priced in yet, and Monday's opening bell could be the moment it becomes impossible to ignore. You're probably telling yourself this is nothing more than a normal pullback after a historic run, and I understand exactly why you'd think that. Stay with me, because the numbers sitting underneath Friday's close tell a very different story than the headlines did. There are 3 things I need to walk you through before this makes sense, and each one builds on the last. First, why the gap between the paper price of silver and the physical metal actually sitting in COMEX vaults keeps widening instead of closing. Second, why the gold to silver ratio just pushed into territory it has only touched a handful of times in the last 50 years. Third, why the Federal Reserve's meeting later this month could either accelerate what's happening right now or slam the brakes on it entirely. I'm not going to sit here and give you my opinion on any of this. I'm going to show you what COMEX data, the Silver Institute, and banks that move billions of dollars a day are actually reporting, and let you decide for yourself what it means. So let's build this from the ground up, starting with where we actually closed the week. On Friday, July 17th, silver settled at $55.20 an ounce, down about 60 cents on the day. Gold closed just under $3,986 an ounce, essentially flat. But here's the part that matters more than either number on its own. Gold was on track for its biggest weekly loss in roughly 6 months, and according to that day's market wrap, the damage was coming from an oil-driven inflation scare tied to the conflict in Iran, not from fading demand for metals. That distinction is everything, because a demand-driven sell-off and a macro-driven sell-off behave completely differently once the dust settles. Platinum told the same story that day, down about 1.1% to $1,199.17, which tells you this wasn't a silver-specific move, it was a metals-wide reaction to an oil and inflation headline. Zoom out further, and silver is still trading more than 50% below the all-time high of $121.58 it hit on January 29th of this year. A drop that size would normally be read as pure weakness, but weakness in price and weakness in the underlying market are not the same thing, and that's where the gold to silver ratio comes in. Right now, that ratio sits up near the high 60s to low 70s, close to the top of its 50-year historical range. Before we go further, you need to understand what that ratio actually measures, because most people who quote it don't explain it. It tells you how many ounces of silver it takes to buy 1 ounce of gold. When that number is historically high, it has meant one of 2 things nearly every time in 5 decades of data. Either silver is deeply undervalued relative to gold, or the market is bracing for a shock that hasn't hit silver yet. The last time this ratio blew out to a genuine extreme was March of 2020, when it briefly spiked above 120 during the pandemic crash, and silver went on to nearly triple off those lows over the following year, while gold moved far less in comparison. That's not a guarantee of what happens this time. History doesn't repeat on command. But it is exactly why traders who understand this ratio don't treat a high reading as a reason to panic. Layer on top of that the inflation picture. June CPI came in at 3.5% year over year, down sharply from May's 4.2%, the first real cooling in that number since April of 2020. Cooling inflation usually eases pressure on real yields, and lower real yields historically make non-yielding assets like silver more attractive to hold. Now here's where the staircase gets its next step. The Federal Reserve's next meeting lands on July 28th and 29th. If that meeting produces a hold, real yield pressure on silver eases further. If it produces a surprise hike because of the oil-driven inflation scare I mentioned earlier, that pressure extends and probably tightens fast. None of that changes the structural story underneath all of it, and this is the part almost nobody on this platform is actually explaining to you. The Silver Institute is projecting a 6th consecutive annual global supply deficit, tens of millions of ounces short of what the world actually needs this year. 58% of all silver demand right now is industrial, solar panels, electronics, EV components, not jewelry, not coins. That means even if investment demand went to 0 tomorrow, the deficit would still exist because the world's electronics and solar build-out doesn't pause for a price correction. Meanwhile, registered inventory sitting on COMEX, the ounces actually available for delivery against futures contracts, has been described by exchange analysts as sitting in stress territory for months. When deliverable supply tightens while paper trading volume stays high, you get a widening gap between what the chart shows and what actually exists in a vault, and that gap does not close quietly. It closes with a move, sometimes over weeks, sometimes over a single session. This is usually the point in a video like this where I would ask you a simple question, but I want to make this one personal, because it matters. Are you the kind of person who waits for the confirmation candle after the move has already happened? Or are you someone who looks at a structural deficit, a 50-year extreme in the gold to silver ratio, and a cooling inflation print, and actually does something with that information before the consensus catches up? Weak hands sell into a 50% drawdown from an all-time high because the chart looks scary and the headlines feel worse. Strong hands ask whether anything about the deficit, the industrial demand base, or the physical supply chain actually changed in the last 6 months. And when the honest answer is no, they treat the drawdown as information, not as a verdict. That is not a sales pitch. That is just what separates people who compound wealth over a decade from people who trade their own fear every single week. Now let's talk about where this actually goes from here, because there are two real paths, and I'm not going to pretend I know which one plays out first. In the bull path, the Fed holds on July 29th, the CPI cooling trend continues into August, real yields drift lower, and the gold to silver ratio starts compressing back toward the low 60s or even high 50s, the way it has after every prior extreme reading. If that compression happens while the sixth consecutive supply deficit keeps draining registered COMEX stock, silver could work its way back toward the $65 to $70 zone over the following weeks, with the LBMA's 2026 analyst consensus of $79.57 and JP Morgan's base case of $81 still sitting well above even that target. Banks, including Bank of America and Goldman Sachs, have both been revising their precious metals forecasts higher through this year as the deficit numbers came in, and the bull path simply assumes that trend continues into the fall. In the bear path, the Iran-driven oil spike forces the Fed's hand. Inflation expectations reaccelerate, the dollar strengthens, and real yields stay elevated or climb further from here. In that scenario, the gold to silver ratio could push even further past its current level into territory almost never seen in 50 years of data, and silver could retest the $54 zone that marked its October 2025 high before this year's run even started. Industrial demand would likely soften too if higher rates slow global growth, adding pressure on top of the macro sell-off and stretching any recovery further into next year. Both paths start from the exact same Friday close, the exact same deficit numbers, the exact same ratio extreme, and the only thing separating them is what happens in the 9 days between now and that Fed meeting. So here is what I will leave you with, heading into Monday. The math on whether silver is cheap relative to gold right now is not really in dispute. The ratio alone tells you that much on its own. What is actually in dispute is which of these two paths Monday's opening move starts to confirm, and whether you will have already decided what kind of holder you are before that answer ever shows up on the chart.